All right, today we're going to build something from the ground up, but not with bricks and steel. We're talking about legal documents. We're going to dive into the hidden blueprints of commercial real estate, the different ways you can actually own everything from a tiny retail shop to a gleaming skyscraper. And trust me, it's a foundational choice that changes everything that comes after.
Okay, so you know that giant glass tower you pass on your commute every day? Ever just look up and wonder who really owns that thing? Is it one super rich person, a group of investors, some huge corporation? Well, the answer to that, it all comes down to something called an ownership structure.
And that brings us to the key idea for today, the ownership structure. The best way to think about it is like the legal DNA of a real estate deal. It is the first, and you could argue the most critical decision an investor has to make, because it's what decides how much control you have, how much risk you're taking on, and of course, how much of the reward you get to keep.
So, what we're going to do is break down the most common structures, from the absolute simplest to the most complex. Because at the end of the day, the big question for any real estate investor is always this: what's the right setup for you and for your goals? Let's kick things off with the most direct route, the one-person show, the purest form of ownership there is, just going it alone. Now, in legal speak, this is what's known as a sole proprietorship. And it is exactly what it sounds like. One person, one property, one owner. You find a building, you buy it, and boom, the deed is in your name. It's as simple as that.
Okay, but the trade-off here is it's a big one. On the one hand, the pros are pretty great. You have total control. It's super simple and cheap to set up, and every single dollar of profit goes right into your pocket. But the disadvantage is a monster, and it's a potential deal breaker: unlimited personal liability. This means if anything goes wrong, a lawsuit, you default on a loan, there's no legal wall between the property and you. Creditors can come after your car, your house, your personal savings. Everything you own is on the table. So, you might be asking, when would anyone ever do this? Well, it's really best for smaller scale stuff. Think about a local bakery owner who decides to buy the building that their shop is in. In a situation like that, the risk is a lot more manageable, and the simplicity is a huge plus.
But let's be real, not many of us can just go out and buy a building solo. So what do you do if you need more cash or you want to go for something bigger? Well, the logical next step is you find a partner.
And that brings us to the general partnership. So you solve the money problem by bringing someone else in, and hey, you get to share expertise too. Sounds like an easy fix, right? But that massive red flag of unlimited personal liability, it's still there, and now it's there for everybody. In fact, the risk gets even crazier because of something called joint and several liability. This basically means that if your partner messes up, and I mean messes up big time, you are 100% on the hook for it, legally and financially, even if you had no clue what they were doing.
Yeah, because of that huge shared risk, you really only see this structure in situations where the trust level is off the charts. We're talking about family members going into business together, or maybe business partners who've known each other for decades and would literally trust each other with their lives.
All right, so if going it alone is risky and partnering up is also super risky, how in the world do the pros own those giant skyscrapers without putting their personal fortunes on the line? Well, they use a much, much smarter tool. This is where we get into the pros playbook, the limited partnership, or LP for short. The absolute genius of the LP is how it splits the partnership into two totally different roles. On one side, you've got the general partner, the GP. This is the doer. They're the expert who finds the deal, manages the property, and takes on all the work and all of that unlimited liability. But on the other side, you have the limited partners, or LPs. These are the investors. Their only job is to provide the cash. Their role is totally passive, and here's the magic word, their liability is limited. It's limited only to the amount of money they invested. If the whole deal goes south, they lose that investment, sure, but their personal bank account, their house, totally safe.
So, how does this actually work? How does the money move around? Let's walk through it. First, the LPs, the investors, put up the money. Second, the GP, the manager, gets to work and tries to make the property profitable. Now, the key is what happens next. Before the manager gets a huge payday, the investors get their money back first, plus a set profit called a preferred return. Only after the investors get paid that preferred return does the GP get to earn their special bonus, the promoted interest, from whatever profit is left.
And that promoted interest, you'll also hear it called the CRE. That's the grand prize for the general partner. Now, it can vary, but a pretty common industry standard is around 20%. This means after the investors get their preferred return, the GP gets to keep 20% of all the profits that are left over. It's their big reward, right? It's the whole reason they're willing to take on all that risk and do all the heavy lifting to make the deal a huge success. And this is why this structure is such a game changer for raising capital for big projects. It finally answers that question. Why would, say, a doctor or a lawyer who knows nothing about real estate put their money into a skyscraper? Well, this is why. Their liability is limited, their role is passive, and their personal assets are totally protected. And, most importantly, the whole thing is set up so everyone's interests are aligned. The GP only gets that big payday after the investors have already made their money. Okay, so we've gone all the way from a little mom-and-pop shop to a massive skyscraper deal. Let's pull this all together now and think about how you'd actually choose the right framework for yourself. When you strip it all away, it really just boils down to this one core trade-off: control versus risk. With a sole proprietorship, you get maximum control, but you take on maximum risk. A general partnership means you're sharing control, but you're also all sharing that maximum risk. And then finally, the limited partnership brilliantly separates these two things, giving investors limited risk in exchange for giving up that day-to-day control. And by the way, even other structures you've probably heard of, like an LLC, they're all just different flavors of this same basic idea, trying to find that perfect balance. And that really leaves us with the big question, the one every investor has to answer for themselves. If this were you, what would you prioritize? Would it be the total control you get from going it alone, the access to bigger deals that capital from a partnership provides, or the personal financial safety that comes with limited liability? It's a choice between control, safety, and capital, and there really is no single right answer. It all just depends on the blueprint you want to follow.